Welcome, everybody, 5 o'clock. And appreciate everybody taking the time to join us today. I would, before we introduce Joe Collins and David Irwin, we have a couple of little business items to deal with. Firstly, to the best of my knowledge, everybody has picked up all their materials, that is vis-a-vis the fiscal year audit materials and the fiscal year budget materials and the audit materials. And everybody has a book. And also, I would ask that if we have any questions this evening, please raise your hand as opposed to just jumping in so that we can have some, some decorum. It's important, and I would appreciate that very much. So basically, the first order of business that we have are the minutes of March 20, our last meeting, which I circulated to you within the past week.
I move their approval.
I'll second it.
Any comments or discussion? All in favor? Steve?
Aye.
Yes? Okay, thank you very much. 3:20. The first is vote. Who did the second? Was
Jim,
that,
doesn't matter.
was Jim? Okay.
This one,
Yeah.
doesn't matter.
Okay, now for the business at hand. We're delighted to have David Irwin, the Director of Audit for Adelson and Company, and his associate Joe Collins with us this evening. And basically, a tremendous amount of work has gone into your June 30, 2023 audit. The document has been circulated to our committee. And basically, obviously, there are a number of key sections in that document. The management letter, as respects the comments and recommendations, both of the current audit period and the prior year. Also, financial statements. There is referring to certain elements of the financial statements, as well as supplemental information. And there is a section in that document for internal controls and compliance with governmental standards. So that's the overview, and I leave it to you, gentlemen.
Okay, good.
All right, and thank you for being with us, and
Yeah.
feel free to ask questions. All yours.
So there's a lot of information inside these reports. So I will hit the highlights. If there's any questions, feel free to ask as we go along. So we'll start with the audit. It's the larger the document, and it says financial statements and supplementary information. And on page 3, it says independent auditors report at the top. So we audited your June 30, 23 year. We issued a clean opinion. So your financial statements are in accordance with accounting principles generally accepted in the US. They accurately represent your financial position as of June 30. We had no material weaknesses, no significant deficiencies, and no non-compliance with grants or contracts or any of that nature. So you have a good, clean opinion, just like you have had for many years. So that is the opinion. The opinion also refers to certain information that's required to be included in your financial statements, which is known as required supplementary information, particularly information on the other post-employment benefit obligation that the town has, and information we're required to disclose for belonging to the regional retirement system. All that information is included in the financials, and nothing wrong or inconsistent with any of that information. So the good thing is, good, clean opinion. Page 6 of the financial statements, we're going to bypass this called the management discussion and analysis. It goes on for page 6-1 to 6-8. And it's going to go through all the information that I'm going to go through anyways when I go through the financial statements. So we can bypass that. And we'll go right to page 7. Now, you got two bases of accounting that are inside your financial statements. Page 7 and page 8 are government-wide statements, meaning they follow the full accrual basis of accounting. So we're capitalizing the fixed assets, we're reporting 100% of your debt obligations, and we're reporting your obligation under the net pension liability and the OPEB. So that's full accrual. Page 7 and page 8 are required for us to be able to issue a clean opinion, okay? At the top there, $14.19 million in cash. Cash accounts were all reconciled timely. There was nothing unusual. We confirmed all of the town's bank and investment accounts. Nothing unusual came back in those confirmations for the financial institutions. We pull a lot of samples, expenses, and revenues that we trace, and we didn't notice anything unusual running through the town's bank accounts other than transactions related to doing town business. So no issues with cash. Investments, $2.7 million. We have money invested in Bartholomew Investment. That's the name of the finance entity. The $2.7 million holds our stabilization funds of about $2.3 million. And it also holds some funds that we have for our trusts, about $358,000. Nothing unusual inside that. Investment was all fine. The amount recorded in the general ledger agreed right to the investment statement, and all that information was confirmed. Receivables, very consistent with the previous year. It's real estate, personal property tax, motor vehicles, some departmental receivables. Everything was fine, very consistent. We have this line item here called, it's under the non-current section, it's called leases receivable. And it's a little over $1 million. There was a GASB pronouncement that came out a few years ago that required us to look at long-term lease obligations, both on the expense side and on the recipient side. And obviously we have some income coming in for some tenants inside the building here. We're required to get those lease agreements, calculate out how much rent we're supposed to receive under the executed lease agreement, including the extension options, discounted all back to today's dollars, and put an approximate value on the balance sheet. The corresponding offset to that is a deferred revenue. That deferred revenue shows up down in the liability section called deferred inflows related to leases receivable. The whole point to the pronouncement, yes, I understand the frustration.
Well, I mean, the frustration is that we're having to, capitalize
Yes.
income that is subject to extensions which have not been exercised.
Steve,
That makes no
Yes.
sense whatsoever.
please raise your hand as we move into this so that we don't jump back and forth. I would appreciate that, please. Thank you. Go ahead, David.
That is exactly right. And unfortunately, the GASB does not word it that way. So a lot of issues with GASB pronounces that have come out in the last couple of years. That is one of the bigger issues. But that's what that means. The whole point to the GASB is transparency. I can see it on an obligation side being more relevant on an obligation side than I can on a receivable side, because it's money coming in as opposed to money going out. But that is GASB statement number 87. Anyways, that came in last year. Capital assets, we had additions of $1.2 million in fixed asset additions. That added to that $32 million. The additions that we added, we had a police cruiser. We bought some photocopiers. We did some improvements to the highway, water, and sewer, some trucks. And we also had some big projects with some of our bridge replacement projects, the Larry Wog and the Alveric Tuckerman Bridge. We also made some improvements to the Chime Tower and to the Park Street Pump Station. Yep.
Go ahead, Ed.
You mentioned, did I hear you correctly that you said the capital assets went up?
Yeah.
Because on page 6-3, they show them going down?
There's two components. The first component is we did have additions of about 1.2 million. The offset to that, the reduction would have been the recognition of depreciation expense, the allocation of the cost of those assets over the useful lives. The depreciation expense in this case here was
Offset
$2,164,000.
going the other way.
That's exactly right. So the net offset would have been a net reduction.
Understand. Thank you.
The fixed asset additions, we traced the copies of the invoices. We didn't have any issues with that. They were recognized properly as an expense in your financials internally following the modified basis of accounting. We grab them and capitalize them under GASB statement number 34 and put them on the balance sheet here. Consistent process that we've followed for many years. We have these two line items here called deferred outflows of resources, and I'll get to that in just a minute. Down in the liability section, warrants payable and accrued interest on our long-term debt, everything was fine. We had no issues with that. We traced the copies of the invoices and the calculation for the accrued interest, and everything was okay. Debt. In total, we have about $12.4 million in long-term obligations. We break that down between the current portion of 1.1 million and the long-term debt amounts being paid after 1 year of 11.3 million. So the sum of those two is 12.4 million. We did issue debt in fiscal 23 of about $3.9 million. And the debt that we issued in the $3.9 million, the $3.9 million is being used for bridge reconstruction, salt shed, fire engine, and also highway truck and wastewater pumps. So that was going to be the use of that 3.9 million. We repaid, met our obligations on our existing debt. So we did pay down $1.9 million. We're in compliance with all of our debt, so no issues there. I do have a separate note on the debt, which we'll be able to see that when we get to that point. Okay, moving down, we have this line item here called net pension liability. So we belong to the regional retirement system, and the GASBs came out quite a few years ago and that said that we're required to recognize our proportionate share of the obligation of that retirement system. So we get information from the Public Employee Retirement Administration Commission. They do an actuary study, and I think the retirement system also gets audited. And we get the information that's connected with the town of Stockbridge out of the actuary study. We run the calculation and we recognize our proportionate share of that retirement system.
Am I correct in assuming that's the Berkshire County retirement?
Yes, that is correct.
That's where you access that?
Yep, that is correct.
Another question or comment. I think for those of you who remember from last year, we expected that number to go up this year because of investment performance. So we can expect it to turn around in the next audit because I think we're going to see somewhat better financial
Yeah, okay.
investment performance
Growth in the assets.
in the next report.
Yeah. Yeah, I guess we'll have to wait and see. The market would have that positive impact on obviously the retirement assets, right? Because this is June 30, 23. The pension plan is on a calendar year. So this is looking at that actuary study with the plan assets in that plan at December 31, 22. And I believe at that time there, the stock market kind of dipped on us.
Yeah, that's right. So we'll see a better result, hopefully better see a better result when we see end of 23.
Yes, that's exactly right, because we'll pick that up in June 30, 24 financial statements. That's
The
exactly.
operative word is hopefully. The operative word.
Yeah,
is hopefully.
let's not.
Well, you know where the result, where the market is at the end of 23.
Okay, let's leave it for, we're dealing with this fiscal year right now. Go ahead.
Sure, yeah. Okay, now the net other post-employment benefit liability, that's $500,000. Now, our total obligation on that is much higher than that. So let's just, given that we're talking about the number, let's zip into the notes real quick. And let's go to page, is it on, Joe? Let's go to page 34.
34.
Okay. So obviously the town offers benefits to its retirees, health insurance and the like. And the town contracts with an actuary company called Odyssey Advisors. It's run by Parker Elmore. And he runs an actuary calculation based on mortality tables and healthcare cost trend rates and all that stuff. And the total projected payout obligations under that is $4.4 million. The town has $3.9 million set aside. So when you net those two numbers together, that comes to that net $500,000. Okay?
I have a question.
Sure.
Steve?
Well, again, it would be helpful, I think, to have at least a number as of the end of 2023, as a note, some kind of footnote in this. Because we may have exceeded the discount rate of 6.3 in 2023.
Okay.
In fact, it's likely that we did. But it's just not a meaningful number. It's a number that gives us a number only through the end of 2022. And we're going to be having a discussion.
Now,
My understanding is that we're going to be having a discussion, David, not necessarily with you, but with the select board at some point about adjustments to the OPEB trust. And I think that unless we have current numbers on the performance of that account, it's just not going to be meaningful.
okay.
Well, I think beyond that, I mean, obviously, we have to let the issue surface. We're not at that point. But the question will come up is when do we access the OPEB fund? Do we access it at 100% certainty, actuarial certainty, or do we do it less than the actuarial forecast and then have to fund greater amounts of money to bring it up to what the exposure is? And that's not something we're prepared to deal with at this point.
Yeah. Well, what I recommend is getting in touch with Parker Elmore. And if the town wants to draw funds out of the trust to pay retiree obligations each year, the premiums, whatever they might be for the health insurance, figure out what that premium is. Inform Parker Elmore the approximate amount the town would like to take out and have him run the modeling to determine how much you can take out while still preserving capital. I mean, you got $4 million in there.
So based on investment income and what you're taking out and so forth and so on.
Yeah, I mean,
It's
that'll
part
be
of the
all be
model.
built into the projection. I mean, you did the $3.9 million. This is looking at June 30, 2023.
I know, I'm aware of that.
Oh, okay. I mean, interest and dividends on that alone was $101,000. Realized gain was 23,000. Fluctuations in the market netted you a positive 108. I mean, $4 million in the account. I mean, I think you have sufficient funds to be able to afford to pay the premiums of the retirees at this point. But how much you want to take out of that and still preserve capital, or maybe you want to maintain a certain funded percentage. I can see that being factored into that, but Parker Elmore should be able to build all that into his modeling and say,
I
okay,
think that's a very good point.
Yeah.
That based on whatever comes down as a theoretical withdrawal from the fund, we should run that by the actuary.
okay.
You know, that
Now,
would be my thought at that point in
okay.
time.
Now the other comment that you had, Steve, that was page 34, right, Joe?
Yes.
These financial statements are in draft form. So I can add a comment on page 34, and I can include that the plan fiduciary net position as of, I can do it as of December 31, 23, if you want that information in there. Divide the plan, divide it, what's in the investment assets. I don't think I'll be able to include an updated number on the projected benefit obligation because that's an actuary determined.
That's fine. That's fine. I mean,
Whatever number you have, whatever number that has been published could be footnoted.
Yeah, so our report is dated the end of February. So I can get the investment statement from the town and say, as of the date of our financial statements, February 27th, the amount included in the investment account that holds the OPEB assets is such and such.
and then we can do the calculation or the town can do the calculation as to the gap between
Yes,
actual
yeah, that's exactly right.
and liability and
Okay.
projected liability.
That's February 2023.
No, February 27,
2022.
2024. So
24, okay.
I'll put that comment in.
That'd be helpful.
Okay.
I mean, the thing I'm concerned about there is that when you look at the discount rate numbers here, I mean, you can see that a drop of 1%, a decrease in the discount rate produces a rather significant increase in the liability. We have no way of knowing if we make it as if the town makes certain decisions about the OPEB account today with the expectation that it is going to be there in that form
Right.
for the next 20 years, then we're not advising people correctly
Right.
as to what they should be doing. So I think there's a kind of note of caution that needs to go in here as well.
And I think the note of caution would be best supported with a quantitative presentation from the actuary. That would be the best, that is the best information we have on hand.
I agree.
Okay?
I mean,
Yeah.
I think that, our auditor has gone part of the way by showing us what a decrease in the discount rate would do to that account. And I think that it's just incumbent upon us to say, be careful as you go forward with this. Don't make the assumption that the discount rate is going to remain the same. If we had been, for instance, at the beginning of FY '22 and we had used the investment yield from the prior year in making these calculations, we would have been hammered.
Well, not to belabor the point, the thought was always that we would be 100% funded before we started to pay out of the OPEB fund. That was one of the basic premises.
I was there.
I understand. We were all part of the decision. And I think we really need to get into this this is not the right forum to.
We're not 100% funded.
No,
No, we're not 100%.
Actuarially,
We're 100% funded.
No, I didn't say that. I said the premise was we would start to withdraw from the funds once it was 100% funded. Okay, that's what I said. And basically, no, we're not at that point. So let's kind of move on, David, if we can.
all right. Well, I want to make sure I get this right. So I will include a comment about what the value of the plan assets are as of the date of our report, February.
Right.
I understand your issue with the discount rate. It's all an estimate, and depending upon the rate and other factors that the actuary includes in the study depends upon whether or not you're going to turn an asset or a liability
Right.
projection going forward.
Right.
So the note of caution, I thought, would have been the fact that I have it if you did 1% higher, 1% lower.
That's okay. That's fine. There's the caution. The caution's right here in the text.
We're
All set.
we were on this page. Okay.
Yeah.
All right. Let's move on.
Well, I hate to, not understand what's being asked.
Footnote, and Michael will share it with us.
All right. Well, sorry, Steve. All right. Okay. So back on page 7 here. So we have a total assets of the town at 52 million. And if you back off the total liabilities of 16.5 million, that gets us down into our cumulative net position. And then we break that down into a couple pots. What we have tied up in our fixed assets, obviously you're not going to part ways with that to settle any obligations. We have certain monies, grant funds and other funds that we have that are restricted for very specific use. And then anything that doesn't fall into the restricted column gets included down into the unrestricted net asset position. So that's kind of how all that works. On page 8, this is the statement of activities, and it reports all of the revenues and expenses for the town. And it does it on a full accrual basis of accounting. So you got legitimate cash coming in and cash going out, but then it's also being commingled with depreciation expense. It's being commingled with change in the accounting estimates for the net pension liability and the OPEB liability. It's got so when you look at it from a full accrual basis of accounting, if you look at the bottom right-hand corner of that page, it says we got a change in that position of a loss of $156,000. But I want to point something else out to you. This is again the full accrual basis of accounting. So you got depreciation expense that's included in that number that's not really being funded at this point because we paid for the capital assets years ago. But if you go over to page 10, right? Page 9 and page 10, this is going to look at your balance sheet and your income statement on the modified basis of accounting, which is the accounting rules that you follow internal. So it's going to more closely match how you budget with revenues coming in and expenses going out. So we're not commingling it with what we're doing with depreciation expense or accounting adjustments connected to the pension and the OPEB liabilities. So on page 10, you can see that the town did in total $13.1 million in revenue between the regular services of the town and the general fund, the community preservation, and the non-major fund is all your special revenue funds and your trust funds. We didn't have any issues with the recognition of the revenues. Everything was reported properly into the general ledger, so everything was fine there. The town did a little over $14 million of expenses. That expenses includes paying all the operating costs, the current capital asset additions, because those are expenses in this basis of accounting, and it also includes payment of the debt. So in total, the direct revenues minus the direct expenses gave us a deficiency of $896,000. Okay. Then we bring in our transfers plus of all of our funding. So when you bring in the borrowing of the money plus the transfers moving in and out based upon the votes taken at the annual town meeting to fund expenses in either fund, we ended up doing a total overall surplus of $3.2 million. Now, way over in the general fund, it says a deficit of $445,000. All right. Now, when the town passed its budget, part of the budgeting process was to use revenue appropriations, free cash and the like to support the budget. All right. The use of free cash to support the budget is really the use of your retained earnings because it was surpluses that you've earned in prior years. So when you use a revenue appropriation, it doesn't come in as a new revenue source. So even though on page 10, where you have in the general fund, you have a deficit of $445,000, there's another report that we do that looks at that revenue appropriation. And when you bring that in, that throws the town into a surplus. So we had all the revenues, all the revenue appropriations cover all the operating expenses of the town. And I'll show that to you in just a minute. So I don't, what I'm trying to say is I don't let that negative number, it'd be a cause for alarm because it's not, because it's not. Okay. And then the capital projects money, you see a big surplus of 3.7 million. And that's because we had a lot of borrowing come in and we didn't spend all of the borrowing because some of the projects were still in process. So that money will be spent down in fiscal 24. Okay, so it's going to cross fiscal years on us. On page 12, let's skip over to page 12 real quick. Page 11 is just a reconciliation of the modified basis of accounting to the full accrual basis of accounting, the difference between the two statements. But you'll see on page 12, we have the budget that was passed, and you can see The revenues, budgeted revenues equal the budgeted expenses, including the revenue appropriations, use of free cash and other available funds. And then we have the actual on the budgetary basis column. And the most important column in this one here is over in the variance column. And specifically in the expenses, you never want any negative spending because you're not allowed to deficit spend in Massachusetts unless it's for like snow and ice. But you can see that the town did not deficit spend any of its categories. So we had all underspending. And then the net revenues was also came in above target as well. So you have a budget variance, positive variance of $700,000 in total on the town. The town stayed within inside the confines of its budget, so I guess is what I'm getting at. So we didn't deficit spend. On page 13, this is the amount of assets that are held for our OPEB fund. It's held in PRIT, public retirement. The pension reserve, the pension reserve investment trust fund there, which is overseen by the state of Massachusetts. And I looked at their financial statements at June 30, 23, and they got something crazy like $100 billion in assets. So your money is definitely in the right spot. And then you can see on page 14, we did a positive net income gain on that of $200,000. And we know we got 100,000 tied up into unrealized gains, fluctuation in the market. But it still was positive $200,000. Interest and dividends was a positive 100 grand. Get that. Starting on page 15 is all the notes, and this is going to go a little bit quicker here. The notes to the financial statements. How we account for all of our assets, our liabilities, revenues and expenses is exactly the same how we've done it in prior years. So we didn't adopt any new accounting rules during the year. So how we account for everything is exactly the same. So a lot of these notes are exactly the same. So we'll be able to kind of move beyond it a little bit. And we'll be able to go down to page 25. This is that fixed asset note that you had noted, Ed. And there you can see the increases and the decreases. And that reclassification column is just reclassifying projects that were in construction and process last year, but they were completed during the current year. So we moved them out of a construction and process and moved it into the proper category so we can subject it to depreciation expense, and which we did do that. Okay. And then construction and process, you can see that $271,000. The bottom of the page, we provided some information so you can actually see the projects that were ongoing. And you can see the big ones that actually got complete was the Larry Wog and the Averick bridges. Okay.
Everett.
Averick, thanks.
Sorry.
It's the only one of those. It should be singular, not bridges. There's one more that has.
Yeah, it's a two-bridge project. One of the two was completed.
Okay, but this one here is a singular?
Yes.
Okay, I'll make that change. Thanks, Bill. Okay, on the top of page 26 now is all the town's debt. And you can see the $3.9 million coming in, and then you can see all the debt payments that we made. So we got $12.5 million outstanding, of which we have had to pay the debt all the way through fiscal 2023. So down below lays out how much we're paying out in principal and how much we're actually paying out in interest on that debt over holding it for the long term. And kind of moving forward, page 31. There's this information on the net pension liability, and you can see that the Stockbridge proportionate share of the entire system is about 3.44%. Now, the Berkshire County retirement system information as a whole, this comes right out of PIRAC and right off their financial statements, is actually not required to be included in the financial statements, but I include it so you can put some relevance to your 3.44% without having to run the math. So that $32.5 million is 32.5 million times the 3.4% is at 1,119,000. And that is the number that's sitting on the balance sheet on page 7 at the front of the report here. That's how that number is derived at. And then just like with the OPEB plan, all these liabilities, because they're long-term projected mortality tables, trying to figure out what the markets are going to do with the investments. They apply a discount rate, investment earnings rate to it, and discount it all back to today's dollars. But obviously a percentage change one way or the other has a significant impact on the amount that we're recording on the balance sheet. So that information, just like in the OPEB note disclosure, Steve, is included in this one here. And then I think kind of moving on, the rest of the information, it goes on to talk more about the OPEB and the net pension liability. The GASB statements require us to accumulate up to 10 years of data on this information here, so we can build some historical trends to make it, and to make the information more easily to interpret. I don't know if it does that. But that's the point that they're trying to get across. So when you look on page 37, this gives the information over the last 1, 2, 3, 4, 6 years on the OPEB. And you can see what that does. I guess the one thing that it really, it's funny that, based on what Steve was saying, one thing that probably should be on the face of this is what the discount rate was used in those particular years. Mm-hmm. You think that would be on there? Because GASB doesn't require that. Or maybe we should consider adding that to the town's bill. And then on page 40 and 41, this gives the detail of all the special revenue funds and the trust funds, the revenues and the expenses. And these numbers agree right to the front balance sheet and the income statement. But a good note for the town, I think, is on page 42. And this is supplementary, it's not required, but the town opts to include it in its financial statements. And it gives the outstanding amount on your real estate, personal property, and motor vehicle taxes. And you can see at the top there, real estate taxes, the commitment for the levy year 23 was $8.8 million. And over on the right, you can see the collection, $8.6 million. So as of June 30, you've collected everything except that $206,000. And when you compare the collection to the commitment, that's 98%. And you go into the levy year 22 and 21, and it's peanuts. That's left over. Same thing with the personal property tax, and same thing with the motor vehicle excise tax, high 90s, 98% plus. So your town tax collector treasurer job there, position, the individual that you have doing there does a very good job in collecting taxes on the town. So we do have properties in tax title. They've been there for years and they got to go through the tax lien process and all that stuff. But, over the last X number of years, you have very good collection on its receivables.
Properties of possession of.
No. Some, yes. Well, don't quote me on that. I don't know if that's true or not. The amounts that we have included in the tax title are the residents that have not paid their tax bills that go back years. And they've been pulled out of the tax receivable general account, moved down to a tax title receivable account, and they get subject to the tax title tax taking process. That's what that means.
We filed November of 2021, we filed for all the properties in land court, take tax possession. So.
Yes.
Not those properties in the courts, but.
Is it a fair statement to say that the process runs 12 to 15, 16 years for resolution?
I wouldn't say typically my understanding is typically a year or two, but
Really?
We're so backed up after COVID with issues and other things that we're just in. But before that, we hadn't taken any properties into tax possession. We had only put them in tax liens. So now we've actually taken them to the next step to gain possession. So our lawyers and that are working on it. They're all filed in land court as of 2021.
Thank you.
All right, thanks, Mike. So that was the audit. We did have some recommendations that came out of our audit. And Joe, do you want to go over the management recommendations? And
Page 3.
yeah, page 3. Now, these are the recommendations. They're here. They're not findings. They do not impact the opinion that we put on your financial statements. So we're just suggesting improvements to existing internal controls that you have to strengthen them, so that the fiscal 24 and beyond is an even stronger year. But these are some of the items that we caught during the audit. So we felt as though it was important to kind of bring them up. If you want to take over, Joe.
Sure. So the first item that we noted, as we were going through the audit and we were going through the accounting records, one thing we picked up on was that there were certain types of transactions, interfund transfers, which were posted into the fund balance on the town's general ledger. So what happened was, the specific situation was there was a transfer going to record the debt payments, which were being funded by the sewer fund. When the transfer from the sewer fund to the general fund was recorded, that transaction hit fund balance directly. And from an accounting standpoint, ideally, what we would like to see is the revenue account being adjusted. So essentially what happened was the general fund, instead of recognizing revenue coming in from the sewer fund, the transaction went directly to the fund balance.
Yeah.
The net effect of the fund balance is it washes out. But from an accounting standpoint, we would like to see those types of transactions separated. So that way you can have an accurate representation of the revenues and expenditures, coming in and out of your general fund and the sewer fund. So we did propose an adjusting journal entry, which we ran by Mike and Cheryl. And the town did post the correction that we recommended. And we did have a discussion with Mike and Cheryl about it, and they understand. So going forward, I think this will be recorded properly.
Yeah, thanks, Joe. And the reason this got elevated to a management letter comment is because there was a couple of transactions that ran through the equity accounts in fiscal 22 as well. They were minor. But when a transaction runs through an equity account, it becomes very easy to lose it. And it becomes hard to prepare a set of financial statements when you're trying to tie out open balances and you're trying to search for transactions. So it's good to keep revenues, expenses, transfers in or out going through the income statement side of the general ledger. So that's why that one there kind of got elevated. Thanks, Joe. Number 2.
So our second comment, as we were going throughout the audit, we just noticed in 2023 in particular that we saw an increase in the number of budget line item transfers between the budget. So one thing we just thought we would bring out was that it's important for the town, both the finance department and also each town department to be monitoring, the budget throughout the year. Make sure that expenditures are kind of in line with, the proportion of the budget. And if there's any issues, kind of work to figure out, are expenses too high for one reason? And is the budget that the town has set, is that going to be sufficient? So we just wanted to bring out that, both the department and also the accountant should kind of pay, close attention to, the budget line items throughout the year to try and minimize any interfund transfers that are needed towards the end of the year.
Yeah, and the reason that got elevated to a management letter comment is because the volume of transfers in between accounts for budget purposes was up quite a bit. So after talking with Mike, we felt as though that the town accountant really should be monitoring the budget versus actual on a regular basis and bring anything of concern up to the department head or to Mike immediately so that those can be addressed at that point, rather than having a large journal entry handling transfers at the end of the year. So, and Mike agreed with that. And Mike also had conversations with Cheryl to address that particular issue. So, thanks, Joe.
Our third comment, the treasurer is bonded as required by state law because it's a cash handling position. One thing we noted when we did a review of the bonding amounts, because the town borrowed that 3.9 million that Dave was mentioning, the calculation that is done, as far as the bonding amount for 2023 indicated that the treasurer's bond should be increased to a maximum amount of $200,000. The bond amount previously was 150,000, but because the town did that borrowing, the 3.9 factors into the calculation. So we just recommended that the treasurer's bond amount be increased to 200,000. And we spoke with Mike and Erica about it, and I think the bond amount was actually increased, right after we spoke with the town about it.
So you're saying that the bond amount adjusts with the amount of debt?
The bond amount adjusts with the amount of cash that runs through their accounts, how much they're responsible for.
Respective
Okay.
source.
The Commissioner of Revenue actually publishes a recommended bonding amount based upon the volume of cash that runs through your accounts. We obviously have access to, the town's got access to that because it's through the treasurer and collector's manual. It's actually part of that manual, so we can actually take a look at that. And the recommended bonding amount was 200, not the 150.
Are there also standards for the bonding companies? In other words, there are, different levels of financial standing for bonding companies.
Yeah, we didn't go that far into it.
I'm just curious if
Oh,
there is.
I don't know.
State has. I'm sure they must.
Yeah.
Thank you.
Yeah, thanks, Joe.
So the fourth comment we had on page 4, there's a lot of different funding sources that the town, draws from when you're setting up your budget, including raising taxes, using free cash from prior years. We have the CPA fund, the Community Preservation Fund. There's the Water and Sewer Fund, trust funds. So when we're putting together that budget statement that David had reviewed earlier, we have to identify all the sources of these funds, which can get complex. So one recommendation that we wanted to make to the town was after you have your annual town meeting and you have your meeting warrant, the town could perhaps prepare a schedule that summarizes each warrant article, that was approved, and note what the funding source was for each vote. And that would help facilitate the financial reporting at year end. So when we're putting together the budget, we know, okay, $100,000 was approved to come from, this particular fund, or this is, the use of free cash, and that kind of thing. Because it gets very complex with, all the different funding sources and the different votes. So a summary schedule might kind of help facilitate the year end.
I actually thought we categorized it. We had free cash and then went through the various issues that were funded. I thought we did that.
Not the previous town accountant, Elaine, she used to maintain a schedule that she actually used to use for her accounting system. Her accounting system looked at how she looked at the budget.
Right.
The exact same way that we look at the budget when we have to pull it into the financial statements. That piece went gone after Elaine had left. And we would like that piece put back because it takes a lot of hours out of the audit when we don't actually have to put that together.
Right.
So we actually built up a template for Cheryl to use. It follows the exact same thing, but it's in a newer format. So we gave it to her, she understood it, so I'm pretty sure she'll use it going forward. I know we got 4 comments. We typically don't have comments here at the town. The town does a good job. Yeah, you have a new accountant. She does very good. But with any town finance, if you don't stay on top of it, things fall apart really fast. So we like working with Cheryl. She does a great job. These are just some of the areas that we would like her to stay focused on, button down, so that they don't cause us problems when we have to get in and do the audit and prepare the financial statements. So, I think that's pretty much it. Thanks, Joe, for going over those.
Yeah, thank you.
So, any questions on the audit? Okay.
How long have you guys audited us?
Let's see.
Close to 12 years.
Yeah, 12 years.
What's the custom in municipal auditing for switching? Please don't misinterpret this question.
Answer that question.
Yeah. I had to ask. In the corporate world, you switch auditors every once in a while.
Yeah,
Things fresh.
I have,
There are no complaints. I'm not suggesting that.
Sure,
we
sure.
are
I understand.
mounting a revolution.
Yeah, I have, I've been with Adelson and Company for 20 years. And there are some towns that have been with us for over 20 years.
Yeah, I'm sure.
So there is no requirement to actually switch accountants, and actually written right into the Mass General Law under Chapter 30B.
30B.
Some of the entities that are exempt from going out to procurement, one of them happens to be CPA. So CPA, legal, architects, so on and so forth. So there is no requirement to actually change. I would say if you had an issue with your auditor, or they weren't doing what they were supposed to be doing, or you weren't satisfied with their reports or their level of responsibility, then you should go out to bid and have a CPA firm that'll actually do what they're supposed to be doing. And Joe and I try our best to give the top level service and stay on top of everything, and be interactive and be responsible and timely to the town and its needs. So hopefully we haven't given you any reason to
No,
part ways with
I
us.
wasn't asking because I just had a major concern.
Yeah,
I knew you firm had audited us for a long time, and I thought,
yeah, we,
wonder how long is,
in the Joe and I do a lot of nonprofits.
yeah.
And I would say about 75% of my nonprofit work is bid work. And they religiously go out to bid once every 3 to 5 years. So, and some I've held for 20 years.
Yeah.
But it is through the bid process. So it's stressful for us. But
Any other comments or questions for David and Joe?
Good job as always.
Excellent.
Thank you very much.
Thank you.
Michael, anything?
Other than the fact we take those recommendations, to heart, and want to get it. So we don't have any of them preferably, but we appreciate getting that feedback because it allows us to strengthen our own internal. I'm meeting with Cheryl every month. The last 3 months we'll be meeting every other week to already identify those budget lines that we're heading toward. Such as right now, what we know that we're gonna end up over at is the compactor. So just trying to not wait until the last 2 months of the year to really scrutinize what we've already started. The process of looking at those. And then, yeah, the bond was increased right away. The other items were already implemented, so.
Okay.
Definitely appreciate what they do.
Steve?
Well, the quality of the financial statement is not only directly related to the quality of your work, but the quality of the work done by our town administrator.
Yes.
Staff, and it shows.
good. I'm happy. You deserve a clean opinion. The town does very good. You maintain good finances. You got good management here.
Can you get us a AAA?
Can you get your?
Yes. I can get a triple A.
So.
Increase the size of the commercial district by 200%.
That's how the next.
That's
Yeah,
right.
that ain't gonna happen.
Yeah, I know. I'm
Okay,
just asking.
and I don't want to belabor this issue, because a financial statement should tell the story and bring out any issues that need to be brought out. So we're going to have a couple edits to that OPEB disclosure. We're going to drop in the value of the plan assets as of February 27th, the date of our report. And I will give some thought to your comment in regards to a note of caution regarding the use of the discount rate. I'll give some thought to that and see if I can't come up with a sentence or two to include inside the notes.
Yeah, I mean, when you look at the county pension system is using a 6.75% discount rate. Currently, our numbers are based on 6.3. I mean, they're just.
Now,
And the funds are invested in the same place, which is interesting.
Yeah.
They all go into that Massachusetts fund.
I'm not an expert in the actuary stuff. I know that the discount rate is a mixture of two rates. It's a risk-free market rate, and then there's a risk rate on top of that.
Okay,
And I do know that the higher the rate that you have, it would have an inverse relationship to the liability if the plan was in a deficit position. So if the discount rate goes up, if the discount rate drops, that liability goes up.
Yeah.
If the discount rate goes the other direction, the liability goes down. If you didn't have plan assets of the $4 million, your discount rate would be down around 2 or 3%, which would drive that liability up.
Would
And
you,
I know that you know that, but anyways, I'll give some. And the other thing that I also want to mention too is the actuaries also have to comply with the GASB 67 and 68. So they're forced into using a certain level of a discount rate by the GASB themselves, depending upon the makeup of the plan, the assets in the plan, and so on and so forth.
It's not so hard to find out the historical rates for that table that you were referring to
I can-
that show the rates.
I can add that in there.
That might, be helpful.
We can do that because we have all the information. So I can add the discount rate. Where'd those pages go, Joe? I'll add the discount rate on the pension plan and on the OPEB, so you have it for all, because we have it. It's actually kind of ironic that the discount rate wouldn't have been. I can see why the discount rate is not done across the broader spectrum, because the column that makes the most is the current column. But anyways, I will add it because it is part of the historical information and we do have it. So that'll be added to page 30.
David, would you
Yeah.
put these proposed notes in draft form when you send them through Michael? Or how would you
I mean,
proceed?
if you're okay with it, I will run any language I do by Michael.
Right,
But it's gonna be, the discount rates are already in your financial statements from the prior year. So there's no issue with that. The adding the sentence about the value of the plan assets for the OPEB has been published inside your financial statement. So there's nothing wrong with that. I'm just adding the subsequent one.
I just would like, I think we run them by Michael,
Yeah.
as
Okay.
like the audit as a draft.
Yeah.
And then we implement them.
I can do that.
I think that's the best way to do it.
I do need a vote though to move forward and submit this stuff. So if you're fine with me running the amendments by Michael, would I be able to get a vote today?
I would make the motion that as Adelson has proposed, notes would be drafted and first circulated to the town administrator.
Don't we?
but that's not the vote.
Not the vote.
That's not the vote. We need-
But we're authorizing Michael to receive the draft notes.
No,
You want to make the motion?
no. Well, let's talk about it because I think the motion is to accept the audit, subject to drafting of the note to
Yes.
be approved by Michael.
Okay.
Right.
All right, so let's be sure. Accept
So I will move that we accept
the audits.
the audit as presented, subject to amending language
Amended notes.
regarding the OPEB.
Discount rate.
Thank you. Paren to be approved by
Michael.
town administrator.
Yeah,
Second.
good.
I seconded.
Okay, all in favor?
Aye.
Aye.
Anybody opposed?
Oh,
Thank goodness.
Okay,
Yeah, thanks for doing that.
I just want to say one thing about this, and I don't want to belabor it, but I know that at some point soon, there is going to be some discussion about withdrawing funds from the OPEB trust. And I think that whatever the outcome is of that discussion, and whatever the recommendation is of this body, that the action taken has to be consistent with the audit. That's my view of it.
well, that's subject to a whole discussion when the time comes.
I agree, but I just wanted you to understand why
It,
I brought this up.
it may not even get to that point.
I don't know.
Don't
I
know.
mean, is that decision would be based on audited numbers.
Yeah.
Yeah.
But, okay,
Yeah,
Not
thank you.
arbitrary or capricious or
Now-
whatever.
the OPEB. We do limited procedures over these numbers
No,
because we're not actuaries.
I know.
So the information that is inside these financial statements comes from Parker Elmore.
We know where it comes from. It's
Okay.
very clear.
So,
So talk to them.
But we have their
yeah,
information. We have
Their
their
reports here.
analysis. Report. Thank you.
okay.
So we understand, I mean, I
Okay,
understand
good.
that.
Okay, we've got the motion, wait to hear from you gentlemen. Okay? Any other business to come before the auditors at this point?
If there is, raise your hand.
Thank you.
Okay, motion to adjourn?
I'll raise my hand on that.
So too.
An hour, huh?
Thank you.